In this video, I'm going to talk about the moving average fake out trading strategy. Stay tuned. Hey traders, a very warm welcome to you. Okay, so let me slide in a little bit closer to the microphone. Right, so this strategy is based on moving averages. As you can see in front of you, I have three moving averages. They are a 50 period, they are a 30 period, and they are a 14 period. So 50, 30 and 14. Now the difference with these is instead of being based on the close, which most moving averages are by default, this is based on the high low close divided by 3, so kind of like the pivot point. Now what we're looking for in this specific strategy is to get on the end of a trend, as we always generally seem to be doing with moving averages, as the price comes back to touch the moving average. So I've got in front of us here a excuse me, a US crude oil chart on a daily time frame with those three moving averages, as I say, and set up exactly as you saw. So we're looking for this criteria. The moving averages must be in the general bull mode. So in other words, the quickest moving average, the 14's got to be up there, then you've got to have the 30, then you've got to have the 50. So you've got to have that order. So it's got to be the purple, red, blue with the color scheme that I've got here. It can't be mixed. You can't have kind of this scenario here where some are around the other. So an uptrend, it's got to be that, and the downtrend, it's got to be the other way around. So in other words, as you would expect moving averages to be running kind of in that kind of flow if there was a good trend. So that's what we've got to see as the first criteria. The second thing is we've got to see the price come back and tag that 14 period moving average. So price is coming back, tagging again, the purple is the 14 period, but not crossing the middle moving average, which is the 30 period. So it's got to come back and tag it, but if it crosses the 30, the trade's negated, we're not interested. So we're looking for the price to come back, tag that 14 period. Once it's tagged that 14 period, we're then looking to go long if price breaks the high of the tagging candle, if that makes sense. Let me show you an example that will make clearer sense. So we have a trend here. We have just about the criteria. We've got the quick moving average and the medium and then the slow. Price is above it. Yeah, all works out. Come back and we tag it. However, we come and we tag the 30 period here. Trade's negated, we're not no entry. Next time we come up, we get the three moving averages in the correct sequence. We come back and we tag that 14 period just there. Great, so now we go long. Let me zoom in a bit for you guys. We go long now on a break above the high of this candle. Okay, so that was the tag. Yes, triggered. We break above the high of this candle, so we're going long, probably in this candle here. Stop. You're probably going to use the low of that candle. Maybe you can use the 14 period as it's trailing up. You can play around with that, I think. And then you're looking to trail it as much as you can to extract as much meat as you can out of the move. So in that crude oil move, you're looking at a big hefty sort of $6 move on that one. And this is quite nice with this strategy, is that the 30 period stops you from getting in. Because the thing you always get wrong with moving average trades, guys, isn't right? It comes up, pulls back, and you sort of buy it, and the thing just blasts through, and you end up getting stopped out. This way, you're never in unless it kind of does that, pushes up, pulls back, tags it, and then goes again. And you're kind of taking that. So it's a momentum type play. Let's look at another example here. And I'll show you some as well where it keeps us out of trouble, which is always a good thing. You can see what have we got here. So plenty of times here we've got where it comes back, touches the 30, so it's negated, negated, negated. Here again we don't get involved with it because it touches the 30. Comes down, we get a little play here. It comes back, we've got the sequence that we want, the purple, the red, the blue. We get a tag around here. Whoops, I've turned the drawing pen off. We get a tag around here, and then we enter here. So a little bit late, but there's still some meat in that trade. There's still kind of nearly 100 points in that DAX. Well, this is a DAX chart. You can see up there on the left hand side in a daily. So then we're not interested now as it's coming back up. Then it starts to go again, and we get the criteria coming in where we get the tag. So we're going long with a break above here. In this case, it's actually a few days later. It takes a while for us to break that high. There's the kind of trigger candle there, and it breaks the high, and we're going long here for a push to highs. This little sequence of events here keeps us out of the trade because again it comes back through the 14, through the 30, no trade. Let's look at another couple of examples. Gold. What we don't want to be involved in is this chop. So this is why it's so important to see the kind of 3 moving averages in the right sequence. And just by the very nature of it, it keeps us out of trouble, generally speaking. So here we are again. We kind of push up. We get a pullback here. And I don't think that criteria is quite right because we haven't quite got that sequence of moving averages that we need. But we do have it on this tag here. It doesn't tag the 30. So we're going long on the second candle in this case, above that high. And look at that, that's a nice trade. And however you manage that, you're sure to have got out with a decent profit on that one. US dollar JPY, finally, we push up. This looks, I don't think we get a tag on that. I'd like to say we get a tag on that because that's a monster trade, but it shows you how good this strategy potentially is. Almost a tag on that one. And that would have been a beautiful trade. Keeps us out of trouble with this full reversal here. We probably get long here and get that little blip at the top, but we kind of keep out majority of trouble here with a little short trade here, isn't there? Little scalp, probably going to be stopped out, break even on that. No trade on this one, no trade on this one. And then this is the one that gets us in quite nicely. It pushes, we've got the 3 moving averages in the sequence, 1, 2, 3. Pushes back to that 14 period, lovely, and then we're in short as it takes through the low there, and there's a good kind of 250 pips on that trade. So that's an interesting setup. Reminder, guys, of the settings for you. It is on a daily chart. I think you could probably use it on a smaller time frame. Wouldn't go too small on it, but I think it's feasible. We've got a 14 period, again, high low close divided by 3. Pretty much all charting packages allowed to do that. 30 period, and the slowest one is our 50 period, all on the same high low close divided by 3, not -3. I think I said -3 earlier. Divided by 3, and we've got the criteria for that. Daily chart, maybe you can go on a 4-hour hourly. Have a look, try it out. Let me know your findings in the comments section below. We've used a broad selection of stuff. There we had crude oil. We had, I think, we had a DAX on there and a USD JPY. So indices, commodities, currency pairs, worth looking at. Interesting. I like it. Needs a bit of refining with the stops, but good trading strategy. Let me know if you like to give it a thumbs up, and if you haven't already, consider subscribing for more videos from me, strategies, and that kind of thing, and other traders on this channel. Take care, guys. Manage the risk. See you in the next one. Bye-bye.